Most people think the stock market is a direct reflection of the economy, but by mid-2026, you're going to realise that's just a myth. In reality, the global markets are dancing to the tune of a single puppet master. If you don't understand how the Fed pulls the strings on liquidity and interest rates, you aren't investing, you're fighting a giant. Right now, that giant is caught in a political war that could change everything you own. To survive this year, we must look past the headlines. Today, I'll show you why "Don't Fight the Fed" is the only rule that matters for 2026, and how this historic clash creates a once-in-a-decade opportunity. We're diving deep into the plumbing of the financial world. Forget the noise. If you know where to look, the Fed's next move isn't a mystery. It's a roadmap to your next major investment win. Welcome back to Sketching Finance. As we enter 2026, the news is a chaotic mess of inflation data and market volatility. But for the retail investor, this noise is a distraction from the real story: Federal Reserve policy. We've entered a new era. Following the pivotal December meeting, rates have settled near 3.5%, but behind closed doors, the internal divide within the Fed is deeper than we have seen in over 40 years. In this video, we use our signature whiteboard metaphors to break down the two biggest levers the Fed pulls. Understanding these levers is the difference between seeing your portfolio sink or watching it defy gravity. We'll also dive into the shocking legal battle surrounding Chairman Jerome Powell. His fight for independence isn't just a political drama, it's a direct threat to the stability of your money and the future of the dollar. Think of the Fed as the operator of a massive hydroelectric dam. Inside that dam is the world's supply of US dollars. This reservoir is what keeps the entire global financial system from running dry. When the Fed wants the markets to grow, they open the floodgates. This is quantitative easing. Suddenly, the town below is flooded with cheap cash, and the price of every asset starts to climb rapidly. This creates the Fed put. It's an unspoken insurance policy. Investors believe that no matter how bad things get, the Fed will always open the gates to prevent the town from ever going thirsty. But heading into 2026, the game has changed. To fight persistent inflation, the Fed began closing the gates. Without that constant flow of new water, even the strongest companies in the town begin to struggle. However, look at the recent data. In December, the Fed halted their balance sheet shrinking. They've decided the system needs more moisture to stay stable, shifting their strategy just as the market reached a breaking point. They've started buying short-term treasury bills again. The liquidity spigot is turning back on, even if they won't call it QE. For you, this means the wind is shifting back to your sails. Smart investors watch the water level in the dam, not the noise in the news. If the Fed is adding liquidity, the market has a floor. Ignore the experts, follow the flow of the cash. In 2026, liquidity is life. When the Fed adds water, assets rise. When they drain the lake, assets crash. We are currently watching the gates crack open once more. Are you positioned to catch the flood? Now, let's talk about interest rates. In our whiteboard world, interest rates are basically gravity. When rates are low, gravity is weak, and businesses can jump higher to expand and innovate with cheap debt. But in 2026, gravity is expected to stay sticky. With rates near 3.5%, that backpack stays heavy. This makes it much harder for speculative companies to get off the ground without real, tangible profits. Analysts call this the neutral rate. It's a delicate balance intended to keep the economy from overheating while preventing a total collapse. It's the Fed's attempt to find the perfect level of gravity. But the Fed is internally divided. The hawks fear that AI-driven growth will reignite inflation, while the doves worry about a fracturing job market. This internal war means 2026 will be a year of volatility. This is the most important math in investing. When a risk-free bond pays you nearly 4%, you stop gambling on shaky startups. The Fed is literally paying you to stay on the sidelines. High gravity filters out the weak. In 2026, only companies with actual cash flow will survive. The era of growth at any cost is over. It's time to invest in businesses that can carry the weight. Here is the curveball for 2026. On January 11th, Jerome Powell revealed a grand jury subpoena from the DOJ. This isn't just about a building renovation, it's an all-out war for the Fed's independence. Powell claims this is political pressure to force lower rates. If the White House takes control of the puppet master's strings, the primary goal shifts from economic stability to winning the next election. Powell claims this is political pressure to force lower rates. If the White House takes control of the puppet master's strings, the primary goal shifts from economic stability to winning the next election. For 40 years, the Fed's independence has been sacred. If those cracks widen in 2026, we are entering a period of massive currency risk. You need to be prepared for a world where money becomes political. On January 12th, global central banks issued a rare statement of support for Powell. They know that if the Fed falls to political whims, every other major currency in the world is in danger. In 2026, the biggest risk isn't a recession, it's the politicization of the dollar. When the puppet master is compromised, you must own assets that exist outside of the political reach. To manage the government's staggering debt, the Fed may be forced to allow the dollar to weaken. Your savings are being used as a pressure valve to keep the national interest payments manageable. Think of the dollar as a measuring stick for your wealth. If the stick shrinks, it takes more sticks to buy the same house or ounce of gold. This is the weak dollar reality of 2026. Hard assets aren't just going up. The currency used to buy them is simply melting. This is why gold and Bitcoin are hitting records. They are the escape hatches from a devaluing currency. Real value investors look for assets the Fed cannot print. If the puppet master chooses to save the stock market by printing more cash, they are sacrificing the purchasing power in your bank account. This is what frustrates everyone in 2026. You see the real economy struggling with high rent and flat wages, while the stock market hits new highs. This gap is intentional and driven by the Fed. Fed liquidity always flows to the top first. The puppet master ensures big banks and AI giants stay afloat to keep the index moving, even if the average person is struggling at the grocery store. Don't wait for the real economy to look perfect before you invest. The market is forward-looking. If the Fed signals a pivot toward lower gravity, the market will take off long before you feel better. Are you feeling the bumpy road or seeing the shiny highway right now? Let me know in the comments below. Understanding this gap is the first step to moving your wealth to the right road. So, what's the plan for 2026? First, watch the water level in the dam. Liquidity is king. Second, mind the gravity. High rates favor companies with real profits, not just AI dreams. Third, protect your purchasing power. If the dollar weakens due to political pressure, make sure you own assets that can't be printed out of thin air. Real value investing is about survival and growth. Investing doesn't have to be a mystery when you know who's pulling the strings. If you found these metaphors helpful, hit that like button and subscribe to stay ahead of the Puppet Master every week. We're tracking these trends to make sure you're always on the right side of the Fed's next move. Thanks for watching, and remember, don't fight the Fed. I'll see you in the next one.